Episode 566, Trading Justice Podcast, bringing it on a Monday, Matt, the President's Day celebration. Matt, my wife is from Paris. You know this, right?
Absolutely.
And she's like, well, is anything going to be closed today? Right? Because, this is her first year living, she's very
America.
familiar with America, has been many times.
What's a President's Day if you can't go to Walmart?
You know, and I'm like, no, nothing will be closed. And I was like, do they have anything like that in France? And she looks at me like, no, that would be viewed as fascist.
Yeah, if there was like a federal holiday and they kept like stores
to
open.
celebrate the president. She thought the whole thing was really weird.
Well, I understand it. I do. We do not celebrate our president as king, queen, and country. They are the president. We have deep respect, appreciation for the office of the presidency. We have a deep respect for the historical importance of the leaders of our country, and we love the two dudes that we celebrate here today, George Washington and Abraham Lincoln. So much about them, deep respect. But at the end of the day, we're capitalists in America. So
we like a day off too, and there's nothing going to be closed, right? So
no, there's nothing going to be closed. No, listen, we're not going to shut Walmart down for Christmas. It's not happening for President's Day. I can tell you that.
I just got to kick it. How you doing? Fun. How you doing on this 3-day weekend?
Doing good. Excited to be here. I love a 3-day weekend. Recharge the batteries. We record on Mondays instead of Sundays. It's fantastic. But I'm excited to be here with you to break down an important week in the market last week, in my estimation. I'm sure you do.
Yeah, it was.
Just a lot of hot and heavy price action coming at us, a lot of news. So podcast today, I'm sure we're going to spend a little bit of time recapping last week, talking about the week that's coming at us. NVDA, say it 3 times in front of a mirror. Got their earnings report this week, and that's going to be the number one event. So let's get at it. Let's have a great pod.
Yeah, and we're going to talk about NVIDIA here in a few minutes. Obviously, anytime a company that's represented 40% of the entire market gains over the last 13 months reports earnings, we're going to spend a minute on that.
We'll talk about them.
But I want to start off talking about inflation, man. And, before we get into narrative shifts and this and that, just break down what was the inflationary data last week.
Yeah, it was a big week last week economically. I mean, last week you had quite a heavy economic calendar, quite a heavy earnings calendar last week as well. But economically here, it was inflationary week. You got the CPI report, you got the PPI report, and then in the middle of that inflationary sandwich, we got a whole bunch of cyclical components such as retail sales, Empire State Manufacturing. But in general, Mark, everything outside of inflation was pretty much a little bit in, a little bit out, a little bit of a miss, a little bit of a hit, very quickly forgotten, quite frankly. I'm not sure about the CPI report and the PPI report last week. Over the course of the last 10 months, the market has embraced a positive inflationary story, that inflation was going on, year over year, 9%. And then as of right now, we're down to 3.1%. And so the last 10, 11 months has been pretty much just inflation year over year coming down. But what we're starting to see right around that 3% level, and this is a known level where inflation can get sticky, is we're starting to see that last hurdle being very difficult to overcome here on inflation. And so where we're at right now is inflation is back in the market conversation. It's back at the central bank. We probably have a higher for longer type of language at the central bank going on right now. And that's because 2 things happened last week. Number one, we got the CPI report on Tuesday that showed not a sizable jump up, but a fairly big jump up from the 2.9 expectation year over year to come in above that 3% to 3.1. The month over month numbers were all both beats at 0.4 and 0.3% respectively. That shows you that inflation is coming back online in the short term. And over the course of the last just little bit, Mark, Mark, as you can see on the graph here, when we're talking about inflation, you've seen a little bit of rise the last few months, 0.2, 0.3, 0.4. That's kind of creeping up on the month over month situation. When you're looking at it from a year over year perspective, like I said, over the last 10 months or so, for the first 6 months of that, down, 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 down. But inflation's gotten real sticky right around that 3%. And so there was a philosophy before last week that inflation was not part of the conversation any longer. It's now firmly entrenched as part of the conversation because the stickiness right around that 3% level. And then when you're looking at the number one reason why we saw that bump up, it wasn't because, food went up dramatically or other input costs went up dramatically, such as energy or oil or anything like that. Shelter index, Mark, is a major problem for the Fed trying to achieve that 2% level. That's the number one reason why I feel 3% is going to get extremely sticky here, is because shelter's really, really, really sticky. We haven't seen that inflationary pressure come out of the shelter index. It's currently accounting for about 60% of the bump up in inflation on the month over month and the year over year situation. And then on Friday, you got the PPI report, which both came in at 0.5 and 0.3. If you're looking at core v non-core, expectations were 0.1. And so pipeline inflation is showing a little bit of increasing input cost in the short term. That should have a slight impact on a bump up in inflation on the headline numbers CPI report over the next few months. But the concern in the CPI report is the shelter index specifically. And I'm not sure those 500 basis point in interest rate increases over the last 18 months has had a sizable impact, if any impact, on the shelter areas of the CPI report. So we're back to higher for longer, Mark, and we're back to a CPI inflationary conversation at 3%. And the end result of this is what does the Fed do? Obviously, for me, it pushes out the conversation on any cut. Any cut that they were expecting in March, that's gone. Any cut that they were expecting in May, most likely gone. Any cut that they were expecting in June, I think there's a conversation for June. But as of right now, Mark, what you're seeing here is inflation coming back into the conversation, not to the level that we were having last time, not to the level of, oh my goodness, this is going to double dip and it's going to create economic chaos. But it is to the point where it's going to take a little bit more than what we currently see in front of us to get that 2% level achieved by the central bank, because 3% is extremely sticky right now.
Yeah, no, and Matt, there were conversations this weekend from Sojan, from Citibank, from Larry Summers, all out with a different version of the same message. Is it reasonable to start discussing whether the Fed's next move is a hike, not a cut? Now, we can debate whether or not that's the fact, and I'm sure we will here just in the next minute. It's been a long time, and it would be one thing if it was one corner or some speculation. You always get that, right? You always get that. But, it was starting to be pretty widespread in under different, people's openly discussing that. That has obviously massive market ramifications. If that
0% of the market expects a hike, that Larry Summers was talking about this weekend. Zero.
Like it's one of those, like, nobody expects that, right?
I took it Larry Summers was talking about what should transpire, not what will transpire. And those, when you're talking about the central bank, Mark, what will transpire versus what should transpire are two completely different conversations on at the central bank level.
Now, you and I are both on the Fed's going to cut, not whether they should, but this is an election year. I firmly on the, because Jay Powell early December was,
Go ahead, finish your thought.
What Jay Powell early December was, it's too premature, it's this and that. And then
It is
2 weeks later did a complete about face. And for me, that was Janet Yellen tapping him on the shoulder saying, this is what we need for whatever reasons, right? Political, debt, all, maybe combination of it all, and Jay Powell got on board. Good soldier, Jay Powell got on board. It's going to take a lot to try to get them off of that. They're going to have to be forced their hand. Too hot inflationary reporting are not going to, force their hand.
Let me just ask you, should the Fed cut? Not will they cut? That's a different conversation. Based on your personal reading of the inflationary condition, when you're looking at the inflationary condition, when you're looking at the economic condition, should the Fed cut?
Of course not.
No, I don't.
Of course, no, inflation, because it's one thing for inflation to be sticky. It's another thing if inflation were to get out of control. And as long as you have problems in lots of areas and no, kill inflation, set out the job that you said you were going to do this whole time.
Yeah, you got to double tap that one. You got to double tap inflation. You cannot just assume it's down. Inflation's the villain in a horror movie. You got to ensure that it is buried, not 6 feet down, 60 feet down. You got to bury inflation. Yes.
But that's not what they are going to want to do. And that's worrisome, but I don't set the policy.
In your estimation, though, they do not have the argument right now to cut.
No, of course they don't.
Okay. For me, coming into this year, I laid out one specific scenario that they could start cutting if there was, all things being relatively equal based on the things that we knew going into this year. Not a crazy credit event in March or some random reason why the Fed would have to aggressively cut that we do not know about. But the things that we do know about, I felt there was one scenario the Fed could cut, and that's if they get their Goldilocks scenario that they had coming into this year. Economically, don't go into a recession. That's not part of this conversation right now. But inflation was a different story 6 weeks ago than it is today. Inflation 6 weeks ago was month over month, year over year numbers coming down, PPI reports averaging less than 1%. That's not the saga over the first two inflationary prints of the year, Mark. If you'll recall, the first inflationary print of the year, I got a little bit concerned about. The second inflation,
and people brushed it off. They didn't even talk about it, though.
No, they didn't. You
didn't have this chatter over the weekend.
Mark, there's something about two. Whenever one thing happens in the market, you can discount that. So I don't blame Wall Street and everybody else for discounting that bump up slightly in January, because it's just one data point on the backdrops of 10 consecutive months of good inflationary data. But now that you've had 2 consecutive months, especially this month, with that sizable bump up in both the CPI report as well as the PPI report. And I would say for me, the bigger concern would be the bump up in the PPI report, especially with where I feel like we're going to be talking about the input cost on oil.
The PPI report was insanely hot.
And so the one scenario they had where they could remove the interest rate from restrictive territory into non-restrictive territory and allow the refinancing situation that Janet Yellen is obviously so concerned about. The one scenario was the one scenario we did not get in the first 6 weeks of this year, and that's the bump up in inflation. You had the argument economically. GDP is perfectly fine right now. We're seeing an industrial boom right now in the marketplace. And so economically, you still have your argument, but inflation, you can't lower interest rates. You can't even discuss lowering interest rates because you know exactly what the market will do with that conversation. You got to embrace the higher for longer language at the central bank. It's going to be interesting on the Fed minutes this week, Mark.
Yeah, no, it is. And you have yields and the dollar yields. If that was a stock, you would have your order placed
so
on the technical.
Let me ask you a question then. Okay, so both of us are on the no, the Fed should not cut interest rates, all things being relatively equal right now.
Yeah, yes.
Okay.
You
And
you
both
do
of
not
us
want to be 70s repeat here.
and both of us are concerned about a double dip inflationary situation, not an economic.
Extremely concerned.
Okay.
No,
You're okay. So I'm just trying to understand the lay of the land here from that. Now, my second question here, Mark, neither one of us feel like the Fed should cut, but when do
okay.
you think the Fed will cut? And let me lay it out a little bit. 2 weeks ago, Mark, there was supposed to be a cut in March.
Yes.
2 weeks later, there was supposed to be a cut in May.
Mhm.
Now we're kind of in that conversation on are we or are we not going to have cuts in June? So I'm going to put the over under the June meeting. Do you think the Fed will start cutting after the June meeting or before the June meeting? And the reason I picked the June meeting, Mark, is right now you do have a majority of the market in June expecting a cut.
Yes, just like you had a majority in March and then May, and they keep pushing it back.
They keep pushing it back, right? Because, for example, in March, right now you have 91% of the market that does not expect a cut in March, right?
Yes.
Well, a month ago,
because a March cut would be insane. Right,
it was 50-50. A month ago, it was 50-50. So obviously they were wrong, and then they shifted that out to May, and well, that's not happening. Jay Powell's been very clear. You know, the amazing thing about it is, Mark, Jay Powell has stated that they're not cutting in May, and yet there is still 50% of the market that expects the May cut. This is the song and dance routine the market plays against the Fed all the time. So again, I'm putting it into June, understanding fully well that close to 70% of the entire market expects a cut before June. But for the Trading Justice podcast, I'm setting the over-under for the June meeting. Do they cut before, as most of the market expects them to cut before the June meeting, or do they cut after the June meeting? Because of political and other factors, I do not believe a hike is part of this conversation, even though I do believe it should be part of this conversation. Before or after June, based on the current environment?
That's right. Okay, this is assuming more banks don't blow up, which is a very real.
All things being relatively equal.
Yeah, I mean, because banks blowing up, which is going to happen.
Banks blow up, they're going to cut.
They're going to find a crisis.
If nuclear war happened, they're going to cut. Yeah, all things.
I'm going to put out a different theory.
Yeah.
All right, here's my theory. The Fed's not cutting until inflation's under control, but they're going to talk about cutting nonstop. Kind of the.
Oh, so we're just doing the prolonged pause.
We're doing the prolonged pause because.
By the way, I said we were going to do the prolonged pause a long time ago.
And so like they're going to try to talk down any thoughts of there not being cut so the yields don't go parabolic, right? Because if they came out and said we're not cutting, like if they had to do an about face, if they panicked on inflation or whatever,
it takes it to the ultimate.
You would see yields skyrocket. You would see markets the stock market just. I mean, you're really overextended positioning and everything. Things would get crazy. They don't want that, right? But I can't, because man, they have spoken a lot. Gosh, we more than they should. I do not think they want to be Arthur Burns. I do not think Jay Powell wants to be Arthur Burns. I do not think the Fed wants to go down as the Fed that screwed up inflation not just once but twice. And so I think they are very hesitant to.
Oh, if they're wrong on double dip after being wrong on transitory, Mark, again, in the current environment, people don't have a long memory of these things. History does, and history would judge this current edition of the Fed as a
total failure. And they are, whatever hatred you have for them, which I do, I find their that's a whole podcast in of itself.
I have
But these are educated individuals.
fundamentally opposed to some of their existence, but a hatred is a strong word.
I just think they serve a certain class of society, you know.
I don't think you
Like,
caught what I said.
I might not have. You know, I'm deep in my own,
Yeah, I gave a little
choosing
side.
my words
I
carefully.
said I question, even though I questioned some of their existence.
Yes. You know, but they don't want to be remembered. They're educated individuals. They're well aware of history.
They're academics.
Where Arthur Burns is brought up as a cautionary tale. You know, like Arthur Burns, I don't know much about the human being Arthur Burns. He might have been the most fantastic human being to walk the face of the earth. He is viewed as a cautionary tale of total monetary failure. And they don't want that. And so I would not be surprised if cuts are not coming to the level, but the talk of cuts is nonstop. That might like play the little game that the Fed wants to play here, right? And then you get beyond the election, and then they can do whatever they feel is actually appropriate. So
I'm not even sure the Fed has to lead that cut conversation. The market has seemingly done it for them. So I'm assuming that was after June.
yes,
Okay.
that is an a detailed reason after.
Where
June.
would you put the first cut?
Not till they have to. For example, if the markets turn,
if the first cut is in September, that is going to be a political argument.
Yeah, but Jay Powell went on 60 Minutes, Matt. He said the Fed isn't political.
Well, there you go. Well, everything's solved then.
They will cut the second there's any turbulence. That's when my first cut is. Like if the stock market corrects 10%, that's turbulence. We can't have that in an election year. If there's banking's blowing up, we can't have those headlines in an election year.
If they cut in September, the only headline that's going to happen is the Fed is trying to help Biden. That's the only.
And your average American probably doesn't know who Jay Powell is, and so
no, it will just be a conspiracy theory, is what it will be. I kind of feel like that forces a July conversation here. I'm anchoring July. I kind of feel like they're going to cut in July. I do not believe the June meeting will get a cut. I think they cut in July. I think they cut in September. I think they cut in November. And I think there's an open conversation for whether or not they cut in December. And I think they cut primarily based on the banking and the financial, debt concern far more than the inflationary concern right now.
And let's be honest, let's bring in oil into the conversation here.
I think you have to bring in oil
because I think this is the appropriate place because, okay, we just had a nice argument and I'm totally on board generally with July being, July seems like an appropriate first cut. Oh, we're not political. It's not right before the election, but it serves the purpose, right?
We're not political. I have yet to meet the Federal Reserve chairperson that was not influenced by politicians.
Yeah, seriously. But all of this is really, really cute if oil takes off here. Because if oil takes off here and not just hang out in its range, oh, it's up this week, right?
Mm-hmm.
If oil takes off here, then you can take all of your cuts and, because then all of a sudden you have a different beast to slay because, Americans don't like inflation. Americans and
nobody likes inflation. Americans, English, French.
Yes,
nobody likes inflation.
But from American political, but you can't have skyrocketing gas prices in election. If you are in charge, you cannot have that.
1,000%. The powers that be is going to try to hold this one back.
But Janet, you need to go out there and sure. And so oil plays, and I do believe, and let's just be clear, I do believe that there are interests shorting oil to keep it in check, right? Because we're dealing with power. Like people used to kill brothers and mothers and fathers for
Morgan
power.
wakes up on a random day that ends in Y and manipulates the oil market. It's not a far cry to
It's not. This is not a outlandish theory.
Goldman Sachs and JP Morgan live in manipulation of the commodity market. So no, it's not outlandish to say the powers that be want to keep asset input costs down going into a very important election year. They're not. Janet Yellen's not just sitting back being like, please, oil don't go up.
No, she's proactive.
Yeah. And again, the proactive, you take it to the point of they'll actually try to impact the price of oil. Whereas I see it as Janet Yellen's going to try to influence the input output from a macro perspective. But again,
I have it as Janet Yellen has her finger on the short button.
You have it on direct. Yes,
that makes sense. I would, like, if that's what I wouldn't be above that. I
think every person listening to this podcast, if you were the president, you would want to do everything in your power to keep the oil down right now.
Now, the thing about it is, though, is that oil is not your average stock, right? You have a lot of factors playing into it. You have China, you have OPEC, you have geopolitical tensions, you have war, you have supply side, you have red hot economies in the United States, you have growing economies, you have stimulus in China. I mean, there's a lot of things. And if oil takes off and inflation becomes not just a, hey, did you see the PPI report? Let's have a conversation in the podcast about it. But if it becomes a, hey, did you see the gas price in an election year? Then all of a sudden the Fed, it's going to be very interesting.
Is why I feel like the market has not given the inflationary conversation the importance that I believe that conversation is due. It's because when they look at what was the number one reason why we were dealing with that inflationary situation, Mark, post-pandemic, and we can talk for a lot of different reasons, right? A lot of different reasons. But one of the reasons is in the year post-pandemic, 2021, oil went from $50 a barrel to a year and a half later, $120 a barrel. That impact on oil and its down the line impact on trucking, transportation, retail, all the way to the consumer who's filling up their gas, their truck or their car to go to work. It has an impact on the cost structure of absolutely everything. And so, yes, I do believe one of the reasons why the market discounts the bump up in CPI, the bump up in PPI, not over this month, but over the last month and a half, and discounts a little bit of the concern is oil hasn't started trending. What does this look like if oil starts trending again? That's a concern I have that I do not believe the market is currently embracing. I kind of feel like you, me, and a couple other dogs have been talking about oil. Those other dogs being Warren Buffett, he dumped a lot and bought up oil last week. I think we're going to start to see a little bit more conversation here on oil, Mark, and we're getting to a point on oil where you're starting to come into what we at Tackle Trading call a multiple time frame situation, where you get multiple time frames on the daily chart, the weekly chart, the monthly chart, all kind of aligning into a potential breakout. And those become really, really, really powerful signals, not just from a technical perspective. You see an improving condition on the daily chart. You go out to the weekly chart. Well, on the weekly chart, you confirmed above resistance last week. You confirmed above all your moving averages on the weekly chart last week. You got a little bit of an open air fill on that weekly chart, and that's after the foundational support level that it tested over and over and over and over again. The only concern you have on the multiple time frame, and I pointed out these numbers last week when we were talking about energy and crude oil as well, is you got the 20-period monthly moving average right on top of the current price on oil. Oil's, I think it's 78.34. The 20-period monthly moving average is right at 80. And so last week I called that top end of the breakout right at 80. And so, Mark, you're kind of staring down the barrel right now at a potential breakout this week. And if you get a breakout on oil, yeah, we're going to be talking about energy components of Tackle Trading all the time. We're going to be talking about that. That's going to dominate the conversation. But regarding the inflationary conversation that you and I are having right now, that is going to do nothing but put input costs, higher input costs into the PPI report, which we're already starting to see. And if you start to have an increase in both the commodity prices, such as oil, gasoline, natural gas, not part of the conversation, but oil and gasoline, and then you add on top of that what we're already seeing from a shelter being as sticky as all get out, that is an environment for double dip inflationary situations. And so as of right now, it's not a massive concern. But Mark, it can get into that.
It became a concern real quick. And the practical thing here, once again, if we were debating this, which I think is the appropriate conversation, we're going to get into NVIDIA here in a second, with the market at some reasonable valuation where you weren't extended, where you weren't a gazillion miles above moving averages, then it'd be one thing.
I discounted a tremendous amount of concerning economic data a year and a half ago when I was calling for a bottom in the marketplace and everybody else was calling for the end of humanity. Positioning on this conversation matters. It absolutely does.
It just does, because
if we're talking at 4,200, I'm not concerned.
I'm not concerned about Jack and Squat and the other. If I'm at 4,400, if I'm at 4,600,
even at 4,600, I'm not concerned about this conversation.
But if you have a market shift in conversation from this Goldilocks, wonderful, beautiful narrative that's been taking place to all of a sudden oh, wait a second. When positioning is high and you're stretched and all of that, well, you need to be aware of that on just what can happen here from a market perspective.
And I think what the importance of this conversation is, if the higher for longer, remember, why we're talking about an all-time high breakout, why we're talking about the S&P 500 at 5,000 at an all-time level, the Dow Jones at an all-time level, the NASDAQ at an all-time level, those were not the case until the Fed removed the language of higher for longer in that November conversation, Mark. When they removed the higher for longer, the market went higher for longer. But if we are going to embrace higher for longer, if there's one thing I know about the embracing of higher for longer, is it caps out the market. The market cannot achieve price discovery after price discovery after price discovery when you're dealing with a market that cannot go up so much due to the higher for longer language. Because the only thing the Fed has to do to tap on the brakes in the market to create a volatility pocket that we talked about last week is to hint towards a change in that language of higher for longer. And so the Fed has not embraced higher for longer, but the PPI report, the CPI report, and a couple of the Fed speeches from this week does bring that higher for longer language back into the conversation. That probably taps out the market. Does that mean the market goes down? No, that's not what it means. It means that the froth in the market probably slows down more than anything here, Mark.
Yeah, and I think that's an easy call at this point, because calling market tops is even short-term tops is very difficult business. But boy,
try to play the game and calling short-term tops, because what's going to create a short-term top here, Mark, is rotation from the aggressive asset classes post NVIDIA into more cyclical components such as energy, which will tap out the market on the top side, but areas of the market that have not been performing will start perform. And so that's more what it means is
but taking the froth out of the market, because when your meme stocks and your most shorted stocks and your trash and your this and that has been partying like it's 1999.
I was fine until things like SMCI go parabolic from 300,000 overnight based on absolutely nothing. That's the froth I'm talking about.
And all of a sudden, as you start a new week, you have a narrative, not shift, but you have a narrative conversation. And, I think that's enough to cap out the market.
Well, and you take out some of the froth out of the market. We're not talking about a valuation above 20 on the forward PE ratio. You take out the froth of the market. We're not talking about the overextended, overvalued conditions as much in the market. It becomes a little bit of a normal market. If there's one thing, I know you hate trending, like strong trending markets. I love strong trending markets. I can't stand froth the same way you can. Like, no trader loves froth because froth just is volatility without any analysis whatsoever to it.
Let's see how far we can take
it out of the money call option. Let's go to the moon, baby. Like, that's not. It's fun every now and then. It doesn't create sustainability long term. And so, yeah, I think it's important to stomp out a little bit of the froth. The same way I think it's important to stomp out the inflationary situation. So I hope the Fed's listening to the podcast this week.
Yeah, no. And speaking of froth, and the thing about it is, you and I have been on the NVDA is not the froth camp for a long while now. In fact, you and I did
super microchip computer is. It's not.
Yeah, no, and some of the silliness we see out there.
It's what NVIDIA. Okay, it's not NVIDIA.
It's Palantir going up 40% because they mentioned AI. Like, it's that kind of stuff.
It's the trickle down impact of what NVIDIA has created on components that just mention AI that are not even AI producers getting a 60% bump up. It's super microchip computer going from 300 to 1,000 on nothing but speculation and hype. NVIDIA went up based on the best guidance report I've ever reviewed in my life. And even today, Mark, when we're talking a little bit, complaining a little bit about the froth in the market, even today, when you look at NVIDIA's valuation, Mark, now, mind you, I could pull up Amazon and show you a high valuation of about 98 here on the PE. NVIDIA's forward PE ratio right now is 32. Is that overvalued? Yeah. Yes, it is. Is all these metrics overvalued? Price to book, price? Yes, it is. But is it ridiculous froth? No, not on NVIDIA. No, is it overextended?
You and I have we've been on this for a long time. Like, we don't see NVIDIA as froth. We don't see NVIDIA as a bubble. We see NVIDIA as any of the elite premium tech plays that over the last 20 years, you have to pay a premium.
Mark, I'm sorry. I think you're going to have to pay an average above 30 forward PE ratio on NVIDIA for the
until NVIDIA gets supplanted, until that story changes, you're going to have to pay a premium.
If you wait for a forward PE ratio to get down to 20 or a normal PE ratio to get down to 20, you might as well just take NVIDIA off the watch list.
If NVIDIA were to collapse from 700 to 500 on no narrative change, no fundamental change, you should start tickling blindly that, right?
That'd be a sizable gap down on their earnings. But yeah, it's not NVIDIA that is the problem. It's the trickle down impact that has created a little bit of a froth. We'll see that slow down after the earnings report. This is obviously the biggest earnings report of the week this week.
That's the biggest event of the year so far. It's not like
getting pushback here.
Like, it's the biggest event of the year so far, by far. I don't think there's been a close second.
In terms of overall market importance, I think
yes,
one. Yeah.
They've accounted for 40% of the gain. AMD, says we can compete.
Mag 7 accounts for 75% of it, and yet NVIDIA accounts for 40% of that. NVIDIA makes up half of the entire gains in the market.
Yeah, it's pretty crazy.
If you took out NVIDIA from the technology blended growth number, it would be cut in half. Out of tech, bro, it'd be cut in half, blended growth.
So, AMD, I have AMD as froth. Why do I have AMD as froth? Because AMD hasn't shown it yet, right? They're like, we have a new chip to do this and that. Well, and NVIDIA's shown it, right? They've shown the market leadership. They've shown where they're at, and they report on Wednesday after the bell. Now, it so transcends just NVIDIA, right? Because this AI theme, which is an incredibly powerful one, narrative, incite the imagination, the possibilities, right? NVIDIA's been at the center of that. They remain at the center of that. It's going to be really interesting, Matt, to me, not what NVIDIA does or does not. I expect a good report, right? I mean, like,
They're going to have a good report. Yes.
they're going to have a good report because I mean, you got to give them the benefit of the doubt. They're going to have one of two things are going to have to happen, Matt, to change this NVIDIA story. One, you're going to have to see a sizable slowdown in companies buying chips, trying to upgrade, right? Trying to stay. That's not going to happen.
Anticipate that happening.
I don't anticipate that happen. Or you're going to have to see a competitor.
Everything in the last 6 months would describe that increasing, not decreasing.
Yes. Or you're going to have to see a competitor come in and start stealing the NVIDIA business, right?
That ain't happening on this earnings report. So,
and well, we haven't seen that in any of the competitors. AMD showed no inclination of that.
Doesn't just the market cap alone allow NVIDIA to gobble up and buy out any competitor?
And there is that we're gigantic, we can stay on top of the game, right? And so you got to give, like, I think until NVIDIA proves it otherwise, NVIDIA is given the benefit of the doubt, right? Just like Amazon was, just like Apple was, just like Microsoft has been, right? You know, they're given the benefit of the doubt that they'll stay on top, right? Until you have a reason to have a conversation otherwise. But what's going to be, and so NVIDIA has obviously NVIDIA implications, right? And just because NVIDIA gaps down on earnings, even if it's a good earnings report, I wouldn't read much into that other than who knows, right? Because you see this all the time, Matt, and you comment on this all the time where you're like, oh, this is institutions doing something, right? Just talk about that for a second. Like how, like sometimes you'll see, like you've commented recently, like on industrial stocks, like, oh, institutions are buying, they just wanted to get through earnings, or energy stocks, they're buying, they just want to get through earnings. You know, what is that phenomenon? Well, it's not even a phenomenon. It's just a standard.
I don't know if that's any one metric you can teach or point to. I think that's just watching and evaluating thousands upon thousands upon thousands of earnings assessments over time. You see certain telltale signs. For example, you get sometimes where there's a 45-minute gap between the announcement and the press conference, right? And the announcement is when the raw numbers come out. And like, for example, if you see the raw numbers come out and the market is gapping up despite there being a miss on the raw numbers, that tells you that's a contrarian analysis that would tell you a large institution had already made a decision to rotate into the stock regardless of whatever was said or done on their earnings, because earnings is the most liquid environment. It's the environment where most shares exchange hands. It's more than any other environment out there. And so there's just telltale signs you see over time between how a market typically functions on a beat against EPS or a beat against revenue versus what they have to say in the conference call. There were a couple times last week, for example, I reported on a company that had gapped down despite beats on EPS and revenue, and I made the comment that something had to be said in the conference call that was not here in the raw numbers. So it's more about how you see the market responding, not on a specific component, but how the market in general responds from a behavioral perspective on beats versus misses, and then how it responds from a guidance perspective. So I don't think it's anything like, I'm not sure you can describe that skill set in a podcast. It's something that you just see over time. You see these telltale signs over time. 4 weeks ago, Mark, after bank earnings, for example, we started seeing the market buy into bad reports. And it was almost like I said at the time, it's almost as if the market, just as long as they said earnings was not just absolutely,
it's not a catastrophe,
we were going to buy this earnings season. And so that was an accumulation of a few different spaces over a couple of weeks, seeing the same degree of behavioral analysis on different components out of out of industrial. You saw it a little bit out of energy last week. You've seen it a little bit out of specialty chemicals, out of basic materials. And so it's these themes you catch over time in earnings season, Mark. One of the themes in this earnings season, for example, is we're dealing with basically 75% beats on EPS. The EPS beat percentage is right north of 3% right now. But the percentage of increasing it, put it like this, Chucky. Let's say you have ABC stock that is expected to come out at $1 and they come out at 101, right? Slight beat on EPS. Well, historically, what would transpire there? Expectation $1, they came in at 0.101, slight gap up, fade down, depending on what they say in guidance. But that's basically what would happen. It would gap up, fade down during the intraday, and then you would put it on a secondary pattern watch. That's based on how you see earnings in general. But this earnings season, it's been $1 expectation. They came in at 1.01, but it gapped up, and instead of slight fade, which is typical in earnings season, it was gap up and then gobble up. And what you've seen is what typically happens is you gap up 1% and then you just you're done. Well, what's happened here is you gap that 1%, you go to 1.5. You've actually seen positive beats get rewarded by 50% more than what they do on average. You've seen misses not get punished as much as what they typically do. And so it's not something that I would say you can just teach this from an analytical perspective, because it's more about how you read the behavioral analysis over time in comparison to how a market handles a beat versus a miss, and then from a guidance perspective. Okay, I'm not sure that answer helps any.
No, it does. It does.
It's not something I can describe like a PE ratio or a PEG ratio, or I can, if you wanted me to identify the 5 different techniques that you got to identify in tracking a strong bullish retracement, or if you wanted me to break down the depths of the bullish retracement analysis, I can do that from an analytical perspective. When it comes to earnings results and how the market handles that behaviorally in comparison to previous earnings season, there is far more art than science on that one.
And so it does, though, indicate that, for example, NVDA can have a great report and gap down.
That is my expectations this week.
Well, I was going to ask you that, but NVIDIA can have a bad report or an average report and get bid, right? There's a lot of pre-planned action on institutional level heading into a given report, right?
I don't know what institution sitting on the sidelines saying, "Hey, we just got to wait for this NVIDIA earnings." So
yeah, no, those decisions been made a long time ago.
Retail might say stuff like that, but the institutions, this NVIDIA story,
they've been in on the NVIDIA storyline a long time now, and so earnings can be, to be frank, as a time that some may want to cash out for no other reason than they just want to cash out, right? Not because they disbelieve or not, that they just want to cash out. And so you said that, one of your expectations maybe is good report, gap down. Why does your gut say that?
Well, because NVIDIA does nothing but good reports. That's all. NVIDIA.
No, but the gap down part of it.
Well, good report. I do think they beat. Low bar expectations here is always the case. High bar expectations from a market perspective, but from a beat perspective, NVIDIA, let me put it like this, Mark. Last year, this quarter, NVIDIA had an expectation right around 80 cents, and they came in at $4.80, and they haven't slowed down since. I'm not sure the market earnings expectations have caught up to what this conversation has been for NVIDIA. I think the reason we're up outlandishly in front of earnings is because I do think they're going to get beats, and I think they're going to get easy beats here. And so, yeah, I do think you're going to get easy beats here. But Mark, I kind of feel like that's a market expectation, not just a Matt Justice expectation. But when you're talking about what you personally expect from a company post earnings price performance, you got to take into account the trend and pattern before the earnings result. You got to take into account the current valuation going into that earnings result. You got to look at the space and understand if the space is also overextended. And from an NVIDIA perspective, Mark, I just have never really seen an expectation that was front run more than NVIDIA here. And so I kind of feel like the path of least resistance following NVIDIA's earnings results is down from here. But I see that more as just a way for institutions, hedge funds, or whatever to lock in profit, not as an indictment on NVIDIA. I would not see a gap down here as an indictment of NVIDIA in the short term, the intermediate, or the long term. I feel this is far more just a technical overextended conversation than absolutely anything else.
Yeah.
And so I think technically, because we're so far elevated over the last 2 months, you're just talking about an oversized price expectation here. I kind of feel like that, like Mark, you've watched the movie Minority Report, right?
Of course,
Okay.
many times.
I was so excited to watch Minority Report, just so excited. I could not geek out more about it. I was so excited. It's sci-fi, it's fantasy, it's Tom Cruise.
It was a new concept too, right? Like we had to see.
It was so awesome. And then I went to it, I watched it, and I came out of the theater, and I was just like, no, bad movie. B minus. And everybody, like Frank was with me, and Dubber was with me, and they're like, "What are you talking about? That was a great movie." And I'm like, no. Was Minority Report a bad movie? No, Minority Report is a fantastic, awesome, good movie.
It's a great movie.
I've watched Minority Report as much as I've watched almost anything else.
That's a great movie. It is objectively just a great movie.
Great movie. But what was the problem? Was it the movie or was it my expectations?
You thought you were going to get the greatest thing that humankind had ever put together in film.
And it just didn't meet my expectations. But you know what, Mark? I've watched Minority Report probably over 50 times since then. I've enjoyed it every single time. I love that movie. So much about that movie I love. But the first time, it was because of my expectations. And that's what I kind of feel is playing out here, is that the market has these outlandish expectations of NVIDIA in the short term because of what NVIDIA has produced in the short term. But regardless of whatever happens on their earnings release, this is not going to be an indictment on the quality of NVIDIA's earnings report. This is not that conversation. This is a matter of NVIDIA beats, but does it alleviate the froth in the market, or does it ignite it?
And that is the question, right?
Yeah,
it's not an NVIDIA.
For me, that's the question.
For me, that's the question. Is because you've had a lot of people get carried on the coattails.
Yes.
Right.
Yes.
A lot, and like AMD and some good. I mean, not just trash out there either. Some good quality companies that have got carried to valuations that are just stupid. Let's just call it what it is.
And Mark, it's not just me with lofty expectations here. The market currently has a 77 point market maker move, which is basically the market expects over 10% movement here. When the market expects over a 10% on earnings, that's a big number. That's a big number. Usually, even some of the most aggressive stocks, you would at market maker moves are in the 5, 6, 7, 8 range, maybe. This is a over 10% market maker move number. The market, just to give you a little bit of understanding, the market, NVIDIA's at 726. The market is currently expecting a gap anywhere between like 640 and 800. Like That's the range that the market is expecting. I'll call my shot. I think the market in general, and maybe this is a little bit of I'm complaining about the froth in the market. I'd like to see it simmer down a little bit, but in all reality, I think this is a conversation of overextended. All things being relatively equal, even NVIDIA, you've just set the bar, and the bar I'm not talking about is the earnings bar, the behavioral expectations bar, the kind of the conversation you and I were talking about. You've been front running the last month and a half from 500 to 726. That bar goes up the higher that price goes up from an earnings expectation perspective. I do not think we gap and sell here. I do think we gap, and what I hope to see here is a gap down and simmer down scenario where we get a gap down and we slow down. And if that occurs, we could be talking about an opportunity, not necessarily just volatility chaos. So a gap up scenario on NVIDIA, I don't think anybody will love that one, honestly. Even if it is justified from a fundamental perspective, it's just going to create a little bit of volatility chaos. A gap down scenario makes some sense. The difficulty from an earnings perspective is going to be earnings strategies going into NVIDIA. I haven't really dialed that in right now, but with the 77 point expectation right around a 10% move there, I would expect a little bit of less volatility than what the market expects here.
I like low delta naked puts on a gap sell-off scenario.
Well, gap down, simmer down scenario, or gap down, settle down scenario would help that. But again, NVIDIA is going to be quietly the most important report of the year, no doubt. Mark, I'll add you one. I don't think it has the importance of NVIDIA to the market, but I am here for the conversation on Walmart this week. Two things are happening on Walmart. First, you have earnings. Expectations are high here for Walmart as well. But Walmart's also splitting 3-1 in a couple weeks from now.
I thought it was 3-1.
3-1.
Okay.
And that's going to put Walmart right around, depending on where they're at going into the split, depending on what happens from an earnings perspective. But that's going to put them right around the $50 to $65 range mark. That's a good zone for cover call analysis on a company that could be a really, really, really good cover call. So I'm here for the Walmart conversation. These are the two big dogs this week. You got NVIDIA, 1A, 1B, 1C. You got Walmart secondarily. And then off the beaten path in earnings this week, you got Home Depot, you got Newmont Mining. I know we'll talk about gold here in a second. And you got Palo Alto Networks as well. Slowed down earnings week.
Yeah, but some big names in there. I mean, Walmart and the consumer, right? I mean, Walmart can form market narratives because of what they do or do not say about the consumer.
Walmart's the catalyst company. Yeah. It's the only catalyst company out of Staples, I would say.
I mean, so you have catalyst companies in Walmart. So what you lack in quantity, you certainly make up in narrative quality on earnings.
At the tail end of earnings season, I'll always take quality over quantity. I'm sick of earnings season. We're 80% of the way through earnings, which is pretty much done. We're pretty much done with earnings season. In general, terrible start. Clawed its way back. Blended growth is going to end north of 3%. But I'll wait to see NVIDIA.
We'll get a final report card next week from you. Let's finish the podcast talking gold, Matt. Terrible potential narrative catalyst, CPI, PPI. Gold didn't really want to have anything to do with that. Gold, like Matt, gold's had the story of 2024 this year in gold has been one of plenty of reason to go down. Dollar yields, narratives, strong economy, strong stock market, strong dollar, strong yields. It has had a plethora of reasons.
I say a shocking statement?
Say it.
A little hot take.
Listen,
for a hot take.
Janet's buying gold?
No, but yes, the central bank is buying gold. Yes, that is that.
Yes, we do know that. Yes.
Are you suggesting Janet Yellen secretly controls the central? Okay, yes, you are. this is my hot take. I am more impressed with gold holding 2K this year, following everything we've seen this year. I am more impressed with gold holding 2K than I am with NVIDIA going from 500 to 700.
Wow, that is a big take, right?
Because I'm dead serious too. I'm not surprised. Are you kidding me? We had that $500 breakout on NVIDIA dialed in for months. That was an easy breakout.
I traded it's traded 6 months in a region.
About NVIDIA was the 600 to 700 one-day journey it took. Gold, so I'm not surprised that NVIDIA is. I'm a little surprised it's north of 700. But I'm not surprised it's north of 600. That's not surprising to me in any capacity. That $600 was our target on a swing trade mark on NVIDIA. Yeah. So I'm not surprised. I am just so impressed. And gold might not hold 2K. It's got a bearish retracement going into a multiple time frame. But given what we have been talking about this year with the dollar and economically just seeing the market do this, gold holding above 2K, yeah, I'm extremely impressed. Absolutely.
It's a big deal. And it's surprising. And we talk about, we use a phrase sometimes to describe different things in the market where it is, gold's trying to tell you something, silver's trying to tell you something, this company's trying to tell you something, right? Like when the price action does not match what fundamental storylines might be, right?
Yeah. And fundamental storyline, Fed's going to be cutting interest rates. That's the fundamental storyline, but gold is not behaving like that because, Mark, inflation is still a problem. And so in the short term, yes, gold will go down as the Fed starts the conversation on rate cuts. Excuse me, on rate hikes. But man, I just, gold should not be above 2K this year, given the conversation we've had this year. And yet it is.
And yet it is.
And yet it is. Now, the question is, what do you do about that? Because to me, the number one thing that's played out here on gold is long-term investors do not give 1 cent about what happens in the short term regarding any other form of analysis here. The long-term investors in gold are not bucking at this economic conversation. They're saying, we're good. We're good here. We want to own more gold. Central bank, we want to own more gold. Private investors, we want to own more gold. Hedge funds, we want to own more. So I just feel like there's a quiet confidence being played out here on the chart and the quiet confidence is being played out on the fundamental side. But that's the reason why we have not seen that 2K violation. I'm impressed. And I was the guy that was talking about the quality of the technical patterns going into the 2K, meaning that was so important so that we can create stabilization above 2K. And even with that, even me being that guy, I'm still downright impressed that it has not closed underneath 2K, given the 3 times this year we've seen an opportunity for it to do, and it hasn't done that. My question to you, Mark, is something's lying to us here. Something's lying to us.
I like this academic game. Yeah. And if you don't know the something's lying game, it is you see price action in multiple assets where when you just take macro narratives, something's off.
Something's lying. So we've been talking about economically cyclical components going up. We're talking industrial, for example, has just been outlandishly good. Outlandishly good industrial has been. It's been so good across the board. Basic materials, another cyclical component, at the 52-week high right now. Basic materials at the 52-week high. Industrials well above the 52-week high. Finance well above the 52-week high. Cyclical components going up. Okay, good. Gold maintains discipline above 2K. And yet the miners, GDX, is at the 52-week low.
Mhm.
So we got the miners as represented by GDX being at the 52-week low. We have gold. It's not at the 52-week high, but it's near it, far more near it than near the 52-week low. We have materials at the 52-week high, industrials well above it, finance well above it, healthcare, which is a cyclical defensive area, well above it. Something's lying to us. And I'll make it as simple as this. Is gold lying to us? Or is GDX lying to us?
GDX is lying to us. GDX got caught.
GDX is lying here, Mark, and got caught in some degree.
Well, at the start of the year, if you remember the start of the year, everything sold.
We were on the catch-up trade on GDX to start the year. The catch-up on GDX catching up to the front running of gold. That's what we were on. That got blasted day one. We haven't talked about it really since. It's been an aggressive covered call environment ever since then. If GDX is lying to us, meaning gold's the real one, right? Gold above 2K is the real one. Industrial doing its trend is the real one. Finance, healthcare, chemical companies out of basic materials. Is if those are all legit trends based on legit fundamentals, then don't we need to get into a conversation on catch-up W formation GDX at 26?
Yeah, we do, because if gold's not going to break 2000, and the start of the year, you had shorts come out and pound a lot of areas, and they've continued. Gold miners have been one of those, right? And when shorting activity gets really heavy, it's hard to compete that against the short term. But if the shorts are not right on the fundamental call, that's where you see bottoms put in, and that's where you see explosive moves go to the other side. And so, I wish it was a better macro backdrop, because you have the rising dollar, rising
reason to own gold to
yes, because the contrarian miners are lying relative to price.
On a negative economic story.
Yeah, something right, where it's
negative economic story would certainly do the trick.
And one retail sales missing is not enough because we haven't even really talked about that.
Nobody cares about January retail sales when December was okay.
Yeah, and so you need.
Can I just give context to what I just said?
Yeah.
I again, very quickly, I'll do this in very short term. The retail sales missed quite aggressively this week, but the entire analysis was consumers got tapped out in December, which means they couldn't afford stuff for Johnny in January, correct?
Yeah, just pretty simple, yes.
And the market moved on. That was retail sales this week.
Everyone has a job. They just maybe will not be able to spend as much.
They got tapped out in the holiday season.
Yeah, and so it's because it's not. Whenever you have the dollars chart look like it does and yields chart, I would argue you should be freaking careful on everything, right?
Yeah, I do agree with that. But let me ask you a question. Let me put you on the spot. GDX. Both you and I covered gold and GDX. On gold, we're a little bit looser here. We've been pretty tight, aggressively covering GDX. Is it time to alleviate the aggressiveness on the cover here?
Well, it depends on how aggressive.
26. The support level at 26, I got a lot of respect for.
It depends. I know you tend to be more aggressive than me on GDX, and I would not be terribly aggressive on any gold cover. I would find a way to cash flow, right? I think once again, dollar yields, macro story. These aren't great storylines, right? You need a bank to blow up, to be honest with you. Which, hey, I think the Fed's facility is ending here in a
was March.
Yeah, a couple of weeks, right? And they're basically, and if you don't know what I'm referring to, they're basically, you would have had dozens and dozens of banks blow
the
up.
regional bank life support system is
the life support system. The Fed is taking it away, and they are taking it away knowing that banks are going to blow up.
Yeah.
Like Jay Powell outright said
So
this on
why do
60
you think
Minutes.
that has not gotten more commentary out of Main Street media, Wall Street media, and even us at Tackle?
That's a good question. Because like, I mean, talk about like financial crisis 2.0 where nobody gives a crap.
Because the Fed has literally stated banks will fail.
Like banks are going to fail here.
Mhm.
And then, one might say
Bank
how
failing
many,
is not news at 6. Like
you know,
if a
but
bank fails in the woods, does anybody hear?
but like the only question is how many are going to fail, like how many balance sheets are
Yeah, are
in
we
trouble.
talking 30 regional banks or are we talking 200?
Yeah, I mean, and so like banks are going to fail, big banks are going to get bigger. Hey, congratulations, America. That's the system you live in.
As simple as that, Mark, that the market has embraced that they don't care as much about banks failing like they did last year during Silicon Valley and the way
Because they know the playbook.
they know the end
I mean,
result is JP
there's a
Morgan
saying
buying.
there's a saying I've heard used that I really like. Knowledge is volatility dampening, right? Where, the more knowledge you have as an individual, collectively as a market, it reduces volatility, right? So banks blowing up isn't really volatile.
Okay, if 20 regional banks fail in March due to the ending of the funding, doesn't JP Morgan and Goldman Sachs and Wells Fargo and Bank of America just divvy them up?
Yeah, of course they do.
Okay,
Because
so does it create the credit crisis that
no,
you are probably referring to?
no, there's going to be no crisis. I don't think there's ever going to be a financial crisis again. I think the next crisis is monetary or one of faith, i.e., you have people rebelling.
Mhm.
I'm being serious too.
Listen, I didn't make a
Like
sarcastic
people,
comment.
people tired of the system and rebelling against the elite, like you know,
My
financial structures.
my wife, who does not get involved in economic or political conversations, is sick of the system right now. So
And so people say, no, I'm tired of
people are sick of the system in general. Even when they can't describe the problem, they
yes.
they they do not like their feeling.
I'm tired of rich people making money when I'm hurting under inflation.
Yeah.
Thus, I'm going to start doing radical things in the voting booth, electing candidates that make Bernie Sanders look like the norm, make Elizabeth Warren look like the norm, both on the Republican and the Democratic Party,
I
right?
was going to say there are people on both sides of the aisle that fit the Bernie Sanders
Yeah,
Elizabeth.
and so when Bernie Sanders and Elizabeth Warren dominate the Republican, the Democratic Party, you do not want to own stocks.
Well, and even on the Republican side of the equation, you are getting more Republicans that are anti-bank.
And so, but until that's not happening this year,
Well,
right?
that's not a
and
24.
and so like banks blowing up, nobody cares because it doesn't change anything, right? Like the Fed's going to come and save the system. Everyone knows that. So yes, we'll certainly
knows that, but how do they save the system? They save it by injecting liquidity into the system.
well, it's not a
And why you want to
terrible.
own gold in the first place. So it all leads to
Yeah,
gold ownership at the end of
it
the
all
day,
leads to gold. It all leads to gold.
or the new
Yeah.
digital
Or
gold,
Bitcoin. Yeah, or
which
Bitcoin,
is
right?
the first time I've ever given it that categorization.
Oh, look at that, making that. And so, yeah, that's probably why nobody, including us, is talking about it, because it's like, unless you own that regional banking stock, which you probably shouldn't heading into March. I'm like, because like unless you're an expert at breaking down those banking fundamentals, right? I would be careful in buying dips in regionals in March.
No. Carrie's not getting love these days. All right. So gold, final thoughts on gold here, Chucky.
Own it. Like
Own
it's
it.
just
Like,
just
yeah.
own it. Like own it.
Can I just say one thing technically here? I could see a scenario where we double dip, give a nice W formation here on gold. Not surprised by the bearish retracement we're seeing on gold. The most interesting price point, though, you got two. Number one, 26 on GDX and 2K on gold. Those
I mean,
two price points are they're both sitting at support. And it has not, it's been a while since gold was at that 20, or GDX was at that 26 handle. So like them both, I think we're going to be talking reversals here. So we'll have that ongoing conversation down the road a little bit here, Chucky.
Yeah, no, but listen, lots of talk about. Like it feels like you're in a big little stretch, right? We didn't even touch upon things we did not touch upon. Silver's frogging us. The fact that you're heading into the two weakest weeks of seasonality in the market of the year, obviously worth, gamma unclenching in the market, right? Like there was a lot to talk about, and there's a big subject we did.
Those are all tackle pro webinar conversations.
And so we will obviously during the halftime report break it down, but I'd pay attention, right? When markets are extending, you have a narrative shift, right? Pay attention, pay attention, pay attention, pay attention, pay attention, because I don't even know if I believe. I don't know what I believe anymore. I was about to say, markings are a topping process. I don't know if I believe any of the old adages anymore.
I certainly do. I still believe in the anchors of technical analysis as played out through behavioral analysis, and I think the combination of understanding technical behavior and fundamental analysis is what it takes to separate yourself from everybody else. So I actually believe more so in all forms of analysis than I.
So we're stretched.
I think we're stretched. Like a great way to complain about overextended.
So we're stretched. Okay.
Just stretched. That's it.
Magnus, listen, I've enjoyed the podcast very much. Send us out.
Yeah, send us out. Last thoughts from me. Thank you so much for being the best part of the Trading Justice podcast, and that's the listeners and the viewers, whether or not you're watching on YouTube or listening to on a podcasting app near you. Thank you so much for being the best part of Trading Justice, and from our sponsor at Tackle Trading. Thank you as well. If you're looking for an amazing education in the financial world, Tackle Trading certainly can provide that for you. So go over there to tackletrading.com, sign up for a free 15-day free trial, and you can enjoy all the goodies that every other pro member of Tackle Trading enjoys, such as our scan reports, our Tackle Trading newsletter that we put out every single weekend, or the plethora of different pro level webinars that we conduct with our pro member community on a day in, day out basis as well. And if you're just finding us, Tackle Trading is the sponsor of Trading Justice, and we also have a YouTube channel that we put out a daily market commentary report on called the Halftime Report. So you can go over to our Tackle Trading YouTube channel as well, and make sure to subscribe there as we go live every single day, 12:30 p.m. Eastern Standard Time. The market is open. And with that said, I hope everybody has a wonderful, wonderful rest of your week. And let us know at team@tackletrading.com if you need absolutely anything.
Have a fantastic week, everyone.